Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Welcome everyone. This is Steve Meisinger, your host for today's ISE webinar. Today I'm pleased that we have Mark Sebastian with us from option911.com.
Optionpit.com.
I'm sorry?
Optionpit.com.
I'm sorry.
My old blog.
Sorry about that. Sorry, Mark.
Optionpit.com.
Sorry about that. Optionpit.com. And Mark's a former market maker on the CBOE, the Amex, and it's currently the... Well, Mark, are you still with the hedge fund or no?
Yeah, no, I'm still with the hedge fund. But I'm doing a couple other things as well.
Awesome. So sorry about that mistake in the bio, but he writes a popular blog, and please, I'm happy to have Mark Sebastian join us. Mark, thanks so much, and I apologize.
Oh, hey, no worries. No, that's fine. I love it's a trip down memory lane. I used to really like writing on that little blog before it kind of turned into a business. So, but it's been a real, I've really enjoyed, one second here. I've really kind of enjoyed starting this Option Pit, site. It's let me kind of do the blogging that I was doing on Option 911 while actually turn it into something where I feel like I'm really helping people. So, it's a pretty rewarding thing. So let's talk about currency, and let's talk about volatility. One of the things that I've really noticed is that people don't take into account that Vega component when they're trading options. Steve, stop me if this sounds unfamiliar to you. I bought this call, and the stock went up, or the FX trade worked, but I didn't make any money. That sound familiar at all to you?
Very familiar, Mark. Happens all the time. Absolutely.
It happens all the time. And, I'm going to let me start my slideshow, but let me actually first share my computer, then I'll start the slideshow. People probably want to see what I'm doing on my computer, don't they?
You could drive the slides. Yeah. You should have access, Mark, to drive the slides.
Oh, so I'm going to use the slides that are on the. You want me to use the slides here that are on. Okay, so.
So you should be able to just use the arrow down.
Oh, that's really cool. That's new. So there's a little, educational announcement. All right, so here we go. Sound familiar, all right? On December 1st, with EUU trading 131.38, a trader buys 10 of the EUU 134.5 calls for $1.50, okay? Now, those calls are about, I want to say, a 20 delta at the time, maybe a 25. I'd have to go back and double check. But, they definitely have a little teeth to them, okay? Oh, no, okay? So 1 week later, EUU, the euro, is trading 132.62, so it has increased in value relative to the dollar, okay? What's the problem is that the 134.5 calls, they've only gained a nickel, okay? And actually, if you let this trade go much longer, they actually start to lose. So what happened here? Okay? Was it too small of a price move? No. I mean, if you consider what our model was saying the delta of that option was, we should have been up, almost 20% on that trade. I don't know about you, but when I'm trading, if I get 20%, I'm usually a happy camper. All right? Was the delta too low? No. Again, we kind of talked about that. The delta and the price move was definitely legitimate. I would certainly say that a 1% move is a legitimate price move. It had enough delta. Time decay. Well, this is a Jan option, and we're 60 days away, so they really haven't started to kind of have that fast decay. So I don't think that would account for that 25 cents that we didn't make on our option. So there has to be some sort of underlying thing missing from the trade. Okay? So can everybody hear me? Everybody can hear me, correct?
A couple people can't. They might need to call in, but Mark, I'll deal with that.
All right, kind. Great. You know, so it's not the time. It's not the time passing. It's not a low delta. It's not a lack of price movement. What is it? Well, the answer is volatility. The trader was beaten by his or her lack of knowledge of volatility and its effect on the trade. You know, if we go back and take a look at one important underlying thing, where's the volatility of those 132s trading? Take a look. You can actually kind of see the actual whole chart shift, and not just shift from here to here. It actually, the yellow line itself shifts downward. Okay? So the trader had the direction right, but the volatility wrong. So if you look, this is a program called AlphaVision. It's made by Aquaman, which is one of my coworkers over at thestreet.com. I asked him to kind of plug this in. It's a three-dimensional view of the volatility surface. And it's hard to see, but you can see volatility isn't just kind of like a thing that's out there. All of these little blocks represent different strikes. All of these little blocks, okay, represent different variances in volatility. And you can see they've got different heights, different widths, different, you know, everything. So that we're dealing with this whole surface. And that is what really is affecting our trade. So we're not just trading the price action. When you buy options, you're trading an insurance policy. That insurance policy can really have an effect on your option trade, especially in something like the currencies, where that currency volatility can really move. Now, currencies as a whole have small volatilities. They're usually in the teens, right? Have you seen a lot of the currencies trade into the 30s and 40s very often, Steve?
Yes.
It happens a lot.
I'm sorry, Mark, say it again?
I said, do you see the currencies trade into like the high 30s and 40s and 50s a lot? I'm assuming that's kind of a huge move. For the most part, when I'm looking at these trades, they hang out in the teens and in the 20s.
Exactly.
You know?
Even the single digits occasionally. Yep. Great point.
Yeah. So, you know, yes, they have low vol, but those vol moves are much larger than in relative terms. Then it's a bigger deal for a 10 vol stock to move from 10% to 12% than it is a 30 vol stock to move from 30 to 32%. It is a much bigger deal. And so because of that, you know, volatility in the currencies can really make a difference on your trade. Okay? Vega. The truth is that Vega component of an option can overpower any gain from a delta. So let's kind of look at what happened with our trade. Okay, you can actually see the vol drop that gets us. This is a map of 60-day volatility over the last 3 months leading up to yesterday. December 1st is right around here. Okay? And I didn't want to fudge the numbers too much by using something like here, but December 8th is right around here. So even though we see that volatility drop, can people see my cursor?
No.
Oh, they can't. All right. Oh, wait, they can't see the pointer. So I need to use a highlighter. Okay. So the first is kind of right here. Okay. The 8th is right here. So you can kind of see this progression down outweighed any progression up in the stock. I blew it away. All right. So that's kind of the real interesting thing about volatility is that, here is a case where we're right and we're still wrong. Okay? That's usually what causes people to get volatility. When they're right and they still lose, that's when it finally hits them a lot of times. Okay? All right, getting long. All right, we all know there are two ways to kind of get long naked options. All right, you can buy calls, you can sell a put. Okay? There are good reasons to trade one or the other. Okay, there are very specific reasons where you'd want to sell one or buy one or vice versa. All right, and I'm going to kind of go through those. All right, buying a call. The times when a call is the best bet. All right, when purchasing a call, the trader is really betting that the underlying is going to rally. Obviously, you're betting that the underlying is going to have some sort of major move upward. You're also betting that the implied volatility is going to increase or at least stay the same. Looking back to our trade, if we had bought this call and then the vol just kind of stayed flat like this, like you can see my highlighter, our call purchase wins and wins handily. We don't even need vol to go up. We just need it not to drop. Instead, it, as you can see, takes a nice drop on us. All right, so that is where that Vega component can really help or hurt you. Okay? Selling a put. The times when a put sale is the best bet. When selling a put, the trader is betting that the underlying is not going to decrease. Now, there's a very big difference between something increasing versus something not decreasing, okay? And that, I think, is kind of a fundamental difference, okay? So the trader is basically betting that that implied volatility is not going to increase or is going to decrease. That's that Vega component. So that's really what it is kind of driving everything, okay? All right, so why? Why is that? All right, if the underlying rallies, both the call and the put should theoretically do well. However, that Vega component can change the game. If the underlying rallies and implied volatility falls, the long call will be helped by the delta, but hurt by the Vega of the option. But the put is a nice winner. This is what happened in EUU. Yes, you know what? The euro picked up value. The dollar fell relative to the euro. Or in the case of EU, the euro rallied relative to the dollar. However, that implied volatility decrease absolutely crushed us. All right? All right. In our EUU example, how would have a put sale worked out? Now, we all remember that I made a shiny nickel. You know what? Even if adding up the multiplier effect of options, I don't think that nickel I made buys a pack of baseball cards anymore. You know, that's the crazy thing. I remember, you know, when I was a kid, baseball cards started out at 40 cents a pack. I got done collecting; they were 99 cents. I think they're like $6 for a pack of 9. We used to get 17 in a pack of gum. I think, Steve, when you were collecting baseball cards, actually the baseball card was the throw-in for the pack of gum, right?
Yeah, Babe Ruth in my day. Joe DiMaggio.
Yeah, right. So no, but you know, we didn't really make anything on our call. If we had sold a put on 12-1, all right, that 131 put, now it has a little heavier delta, but we would have bought it back for $1.85. That's 7 days later. That would have been 80 cents. Based on the delta of the option, the delta is around 40. Okay? Even if we account for the delta, what's a $1.25 times 0.4, everybody? Actually, the delta wasn't that high. What was the delta on that 131? yeah, I mean, $1.25, we would have made 50 cents maybe from delta, something like that. And that's if the delta was 40 cents, or was 40. If the delta was 35, I don't specifically remember exactly what the delta was, but we should have made about 50 cents from delta. The time decay was maybe a nickel. We actually made an extra 25 cents because that Vega component, at least, okay? So in that case, if we'd gone in and sold the put instead of buying the call, we got long, but differently, we would have made a lot more money. If I make 50 cents if I make 80 cents in a week, I'm usually a pretty happy camper on that trade. Okay?
I'm not being ugly, but how do we know?
Somebody is, I can hear somebody talking in the background.
Oops, okay.
Somebody does have
Somebody's got to mute. Somebody's got to mute themselves.
Right.
I'll
take a look.
If you're listening in,
You know
please.
more than I did. It's everything that some friends been telling her.
Got a lot of call-in users. If you're a call-in user, please make sure the intake on your phone is muted.
Yeah,
thank you.
All right. I already have a short enough attention span. I don't need. So the key here was you can actually see what happened. Okay. Here's that IV, and here's the stock movement. You can actually see how they line up. Okay. We do get that big pop here. You get that big drop in volatility. That put sale outperforms, because of volatility, handily the call. Okay? If you owned that call to expiration, if you bought that call that we purchased for $1.50, even leading up to today, you're probably not making very much money. You probably are finally kind of getting to break a better than break even. You finally kind of broke through around beginning of January when the euro started to pop again. But this whole time, you would have been out of your put trade by probably December 10th at the latest. You would have been the euro would have popped to 134. The vol would have been a full 2 points lower than when you sold it. You probably would have collected. You would have collected about. You would have collected 50% of your cash flow. You're done. Okay, you're out of that trade. And the reason is because you used volatility to your advantage. Okay? Any questions so far?
Well,
It's You're like an old person. I can hear. This is unbelievable.
I
can hear somebody.
Yeah. If you're on the phone, please mute your phone.
Thank you.
Thank you.
Not that, it's not that we don't like the sound of your voice. We do. Okay. It's just, it's my turn to talk.
Exactly.
I'm kidding. But, looking back at this chart, you can actually kind of see what works and what doesn't. Here we have high vol. A put sale works for a long time. Okay? Here we have some low vol. Maybe and at the same time we have the price topping out. This is something I'm going to talk about. Then we've got really low vol here. And we have the price increasing and then bottoming out. Now you're saying, let's take a look at here though. What do you think happens? We get this huge bottoming in volatility that we match with kind of this low price. The neat thing about volatility is that if you're wrong, that volatility can actually protect you. Come on. There's got to be a way to undo that.
Yeah,
you can click on the eraser mark on the top.
Oh.
Eraser, you click on it. If you click the eraser.
Oh, nice. That's nice. I like that. If you line up, let me erase this as well then. So if you line up, you know, the stock really does drop right here pretty quickly. The neat thing is if you bought a call, like that 134 call, it held its value a lot better than if you had just bought, if you'd sold a put. That put on this, if you sell a put here, okay, because you think it's going up, that low vol, you get burned both twice. You lose on the vol, you lose on the delta. If you buy the call, you get burned by the price. You get helped by the volatility. So you actually can end up in much better shape. All right? So let's walk through another one. Getting short. I'm going to walk through getting short, and I'll show you on a UU again. All right? There are two primary ways to get short. You can obviously buy a put, and you can sell a call. Like getting long, that Vega component can help a trader improve returns. All right, buying a put. The factors that make a put the better bet. When purchasing a put, the trader is betting that underlying is going to fall. Okay? That underlying is going to fall. And they're also betting that the implied volatility of the option is going to increase. Or, again, at least stay the same. Okay? If you buy an asset, if that insurance value holds, then that delta is reliable. If that insurance value moves around on you, then that delta is unreliable. Okay? Let's not forget, is the delta, here's a good question, all right? Is the delta real? What is delta, what produces delta? Traders, what produces delta?
Right,
Right,
Mark,
Mark,
the idea that options are either worth their intrinsic value or they're worthless at expiration, but the delta's giving you something else in between, correct?
Mm-hmm. Somebody's saying proximity to the underlying. What produces the delta is actually, you know, it is a proximity to the underlying. That's one of the components. Okay? Delta, just like all the other Greeks, is produced by a pricing model. It's not a real quantifiable thing. Let's talk about some other things that have been produced by models, by modeling. Okay.
Sounds like a
credit crisis.
The Challenger space shuttle, the Columbia space, a lot of these space shuttles, the 787. A lot of bad things have been, heck, derivative modeling. A lot of these CMOs and CMAs have been produced by modeling. Okay, so if delta is just a model, that input, that volatility input, if that changes that delta on you. That's a really important thing to remember. Okay. Everybody seems to forget that. They look at that delta and say, this is my delta. Well, not true. Okay? This is your delta should all other things remain equal. Okay? What is the term ceteris paribus? Is that what they say? I used to have an economics professor that said that. He'd walk in and go, ceteris paribus. It was all he preached ceteris paribus like an old style Southern Baptist preaches the Bible, you know, ceteris paribus. You know, I love it. So it was just great, the passion he spoke with. But the reason why he said that so often was because he wanted us to understand that it's all other things being equal, constantly what you're looking at when you're looking at the model. And the one thing that we can't really comprehend is this volatility component. Okay? It is the one thing that is going to change everything you're looking at. You know you can quantify your price. You can quantify your timed expiration. You can quantify everything. The only thing we can't really quantify is volatility. Okay? So when we're buying a put, getting away from my my little rant/tangent there, that Vega component, that volatility, is going to drive whether that put is going to be a better trade or not. If vol falls in the put, it can lose delta. It can just not work as well. Okay? Selling a call. When betting a stock is going to drop, there are factors that can make a short call the better bet. Okay? When selling a call, the trader is betting the underlying is not going to increase. Again, notice that underlying decreasing versus underlying not increasing. All right? The trader is betting that implied volatility of the option is going to decrease or at least stay the same. Okay? That's that Vega component again.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.